Now, one of the biggest drivers of global risk-taking over the last decade wasn't just the Fed, it was cheap funding, specifically the carry trade, borrowing in low-rate currencies and investing in higher-yielding assets everywhere, especially the US. Now, for years, the yen was the cheapest funding currency in the world. That cheap yen quietly supported global risk, including US equities, credit markets, and emerging markets. Now, as long as Japan stayed close to zero, funding was cheap, stable, and predictable. Now, that made risk-on environments easier to build around and easier to sustain. Now, that is changing. So Japan is slowly tightening, while other central banks are holding or even cutting rates. Now, as rate differences narrow and the yen starts to rise, funding costs increase and currency risk comes back into play. Now, when funding tightens, risk doesn't unwind slowly. Usually leverage comes off and then the volatility rises. Now, US equities feel that impact often without any US specific news. So you usually see this first in the FX markets. Now, the yen strengthens suddenly, the USD yen drops even without any headlines. Now, that's why risk on and risk off look a little bit different going into 2026 than the previous years. So it will be less about sentiment and more about funding conditions. So in 2026, US equities won't just trade earnings or the Fed, they'll trade funding. And the yen will often flash the first warning signals in that cycle. So if you want to stay on top of these shifts in real time with daily updates and live sessions, you can join our free Market Intel group. The link is in the description.